Right, well, the US markets, they were boosted on Friday. In fact, we saw a little more of that in the overnight session as well, following the release of that jobs data, with some weakness emerging in wages growth, but also with the services PMI as well. What's the outlook from here, particularly as we head to that latest inflation read coming to us in the States at the end of the week? Well, joining us to discuss that, Clifford Bennett, Chief Economist at ACY Securities. Clifford, good to see you.
Good morning, Andrew.
Happy New Year.
Yeah, Happy New Year to you too, and I'm looking forward to us doing our best show ever.
Oh, well, no, you've really set the precedent there. All right, so we're talking about Happy New Year. Should we be looking at the point where we're at the moment with confidence? I just mentioned some of that data we've just had, and of course we'll get that CPI read later in the week out of the States.
Yes, I think confidence is appropriate. Confidence that the US economy is going to go into recession.
Right, okay. Confidence has been negative, right.
Yes, and look, the market had a very good run for 2 days straight up, 3 days in fact, vertical almost, very impressive price action in the US stock market over the last few days on the back, as you said, of that data last week. But that IMS services PMI, ISM services PMI, going into contraction for the first time since 2020 tells us that most of the US economy was already heading into recession in December. So it doesn't bode well for the first quarter. Everyone's focused on interest rates. But from here on in, interest rates, even if the Fed stopped now, they're too high for the economy, they're too high for investors, and they're going to stay there. But we know they're going a lot higher. I'm seeing another 2, 3, 50-point rate hikes from the Fed. But even without that, the central game going forward now is going to be the state of the US economy, and it looks a little dire. So I would be very circumspect about the current rally, and we did see the price action in the last 24 hours. The trading in New York went straight up like a SpaceX rocket, but came down as well, sort of landed safely, but back where it started. And I think that's a very bearish price action indicator. Now, everyone knows the inflation number in the US is going to be better. So I think a lot of people have got long going into this week for that improved inflation number. But how I'm looking at that is that an improvement in the inflation number is good, but it's still not good enough, and the Fed will continue to hike. And in any case, regardless of inflation, what the Fed's doing, the US economy, with or without rate hikes, is probably going into recession.
So what do you look at the market action then in relation to that, certainly as far as those bond yields have come off recently? The US dollar, what are you seeing there? Do you think this is a temporary reprieve, or are you looking for continued strength there?
Yeah, I saw that the US dollar was beginning to become a bubble last year, but I didn't sell it, which I'm sort of kicking myself for, because there's been a good down move in the US dollar. I'm wondering if it could be basing here. I particularly think the Australian dollar is vulnerable, because even if the Federal Reserve slows, we know the RBA will underperform in rate hikes vis-a-vis the Fed, which means that every time the RBA hikes interest rates, it's actually a signal to sell the Australian dollar if you're trading it on a yield basis, because it means the yield spread will widen, be stable or widen. Everyone's bought the Australian dollar recently for the reopening of China, which is fantastic. That's great for the world economy. But still, the reopening of the Chinese economy can only do as well as the global economic environment. And I think one of the things some people need to consider is that the global economic slowing is in full force, and it is primarily driven by the United States, Europe, UK. So it's a Western economic driven global slowdown. And China wasn't helping with its lockdowns, but its economy has been growing more steadily outside of those lockdown periods, and it will do so, but it can't go at a super boosted speed when the United States and Europe are really still economies that are slowing.
Don't you think, though, as far as the Australian economy is concerned, that we're more likely to be dragged higher by China than dragged lower by the global economy?
Yes, absolutely. Absolutely, Andrew. I mean, in the GFC, I wrote that big C saved little c, China saved capitalism. So because, the GFC, everyone was panicking, but the Chinese economy managed to remain robust, and that gave an anchor for everything else to recover. I don't think it's going to be so much China as the rest of Asia this time. It's going to be all of the smaller economies of Asia having come of a sort of critical mass age, if you like, and they have their own internal demand-driven economies now. And I think Asia as a whole is going to continue to hold up rather well compared to the United States and Europe. I still think the trade is buy Asia, sell US. Europe could turn around a little bit if there was any good news coming out of the NATO-Ukraine Russian situation, but I doubt we're going to get that. In fact, we could see surprise negative news on that front in the coming month or two, as there is some anecdotal evidence that Russia is preparing a fresh movement against Ukraine, which will be far bigger than the initial invasion. So that's something that we can't ignore. We don't like it, we don't want it to have happened, but as an investor, a global investor in particular, you can't sort of look the other way from that. I think people should keep their eye on that as well.
All right, so more broadly, investors perhaps being buoyed at the moment by, that perceived weakness in the US with some of that data, with perhaps the prospect that the Fed may at least ease its pace of hiking. But of course, the next event to look at is earnings season. Expectation that those earnings will come off.
Yes.
To what degree, though, do you think?
Well, I think earnings will decline. I think we need to, a lot of expectations will be exceeded, because what happens is the people setting the expectations, they want to outperform. So the boards want to outperform their guidance. So they always sort of lowball it to look like they've done better than expected, but nonetheless, earnings will be slowing, and earnings going forward will be far more driven by economic growth than they were in the last couple of years, where earnings were driven largely by ridiculously low crisis interest rate levels for too long and huge stimulus measures and money in people's back pocket to go out and spend. So it wasn't really driven by genuine economic growth earnings recently, the last couple of years. Going forward, it's going to be about economic growth, dominance, and that looks rather ugly.
Is the key, does it remain jobs in the States?
Because it's not jobs.
But I mean, we're starting to see those layoffs. We certainly saw it in tech in the last year now. I mean, the likes of Goldman Sachs overnight indicating it's going to cut around 3,000. Would that not be the sign, perhaps, that those rate cuts are really starting to take effect?
Oh, they are.
Rate hikes, I mean.
Rate hikes, yeah. No, they are. They're biting hard. The thing is, the Fed wants them to bite hard and wants them to bite even harder. So it's going to take a lot more than just a couple of months of soft economic data and a lower inflation number that's still absolutely high before the Fed will take a pause. And even when the Fed takes a pause, it may sit there for 18 months, 2 years. So there's no pivot coming. So it's, the Fed's target rate is a long way off still, even by their own measure. So I think you're going to have increased pressure on the US consumer. So people can be keeping their jobs, and maybe there will be increased layoffs, but people can be keeping their jobs. But not only do they have less surplus spending capacity, given recent events, but they also now have a mindset that is very aware of the potential for a recession, and they're going to start to retrench hiring, retrench consumer spending. So that's how it's going to sort of snowball, unfortunately, for the moment. I think it'll be the second half of the year before we even see the bottom in the US economic slowdown. All
right, and of course you've had some time off to ruminate about the Australian economy, what the RBA is likely to do next. Have you altered your view, of course, over that time?
I think they've found themselves a nice little comfortable niche here of 25-point rate hikes. I think until inflation is much lower, they'll stay the course on that so they can seem reliable. I mean, they've copped a lot of appropriate flack. I don't think the government inquiry into the RBA has had quite the right terms of reference. They should have been looking more at the actual performance of the RBA, which has been dire and hurtful to Australian families. But I think now they will try to, they're so keen on being seen to be responsible to keep their jobs at this point that they'll continue to do 25-point hikes.